Good evening, everyone. Time for another silver update. We're going to start out with the question of the night. The silver chart is pretty boring. There's nothing really going on. We had a little smackdown this morning and then a rally and recovery. So I want to start off with a question, and then we're going to go to the main topic, which is a little bit related to that. Will countries continue to manipulate silver even after the new currency system? This is from Zihu. Hi, Brother John. I've just been asking around in China about the purchase of physical silver. There you can buy silver from banks. However, unlike gold, you cannot store it in the bank. Moreover, banks do not buy back physical silver from the people. Do you think that there is some kind of government effort in controlling silver? As we all know, silver has a lot of industrial use. It might be in the interest of almost all governments to keep the silver price stable for the development of economy. The next question all of us may have is that all governments may continue to suppress the price of silver even in the new currency systems, just like how the food staple prices are kept artificially low in China. What is your opinion on this? Just to follow up to the previous, if you still believe in silver, what kind of silver should we buy? Coins versus bars, and which brand? Thanks for your hard work. Well, I've covered that a lot. You can watch my past videos. My opinion is I like coins. I like coins by the well-known mints, the Perth being my favorite, and then the RCM, and of course the American Eagle, and there's others. I like those for a number of reasons. You can watch my past videos to see those explanations. But the main question here is, are the governments controlling silver, the price of silver? Yes, I think they are, but I don't think that the food staples analogy is really correct, because silver is not like food and staples. Silver is a resource that primarily comes from mines, although there is some scrap and recycling, etc. But the recycling is stymied by the very, very low price of silver, artificially low, suppressed price, and that causes it not to be recycled and salvaged. The government can subsidize food, and they can make as much food as they want if they want to keep the prices low. Russia did that with potatoes and vodka, and other governments have done that. But it's not the same with silver, because ultimately the market will out. And I'm going to show that in the main topic of the night when we take a look at primary silver mines. Now, I suppose that the governments of the world could subsidize silver production, and they could use tax monies to produce silver at a low cost and to keep their industries in low-cost silver. I'm not really sure why they would do that, and of course that would just cause silver to be used up and wasted even faster. So it would be kind of a self-defeating thing. If they're really interested in future industrial use, and of course the best thing they can do is let the price rise, because if the prices rise, then much more silver is going to be mined as a result, and much more silver will be recycled as a result. And so letting the free market go and set the price would be the best thing for the silver market and for the industrial users. Now, so I don't really believe the Silver Users Association definitely is involved, but I don't think the Silver Users Association industrial users are the primary drivers of the silver suppression. I think it's silver's close kinship to gold, and their being monetary metals is the cause of the suppression. Now, I wanted to take you to some charts, but before I do that, I want to read an article from Bullion Bulls Canada. This is a very important article that was written actually last year by Jeff Nielsen. But before I do that, I want to read a comment, because this is a comment on the YouTube channel, and this is a frequent question that comes up. This is K. Crone 1. He says, John, why in the world can't anyone peg an exact price to mining silver? I can't believe we still have people saying anywhere from $30 to $7. I know it's a byproduct, but you can't tell me that the big mining companies don't have this dialed right into an exact or close to an exact cost number. I just don't get it. So let's look at our explanation. It's actually going to be in this article by Jeff Nielsen of Bullion Bulls Canada, an excellent article, and I'm going to read the whole thing. One of the problems with soaking up the conventional wisdom on any particular subject is the risk of mistakenly being misled by a widely held misconception instead. Such is the case when the subject of primary silver mines comes up for discussion. Any investor even modestly familiar with the red-hot silver sector will know that the majority of silver currently mined each year is produced as a byproduct of other mines, roughly 2/3 of all silver production. In other words, contrary to the vast majority of other metals, silver is unique in relying upon this incidental production to satisfy the massive and growing demand for silver, both as an industrial metal and as an investment insurance good money. There are many supply-demand dynamics which flow from this current paradigm of production, but even before we get to those factors, we need to analyze how we ever reached this current scenario. Certainly throughout thousands of years of history, silver mines, i.e. mines which primarily produce silver, have been just as prevalent as gold mines, subject to the qualification that local geology will make one or the other more predominant in a particular region. The obvious question then becomes, how did the precious metal sector evolve into the current state where, on the one hand, we have most gold still produced from gold mines, i.e. primary gold producers, while with silver we are dependent upon mainly byproduct production for most of our silver? The answer can be reduced to one very simple equation: the gold-silver price ratio. While most informed precious metals analysts, including myself, will state unequivocally that gold is undervalued today, the price ratio of silver to gold, which has averaged roughly 15-1 over 5,000 years, is currently at the still extreme level of more than 40-1, and that's even worse right now, despite the explosion of the price of silver in 2010. Thus, if gold is cheap, then silver is dirt cheap. Part of the reason why the general public has been inadequately informed or arguably misinformed by experts within this sector is because of the failure to engage in the most preliminary step of all analysis: definition of terms. When we define a particular mine as a primary gold producer or primary silver producer or primary lead producer, we do so on the basis of the revenues produced from each metal and not the quantity of metal produced. The reason for doing so is obvious, because each of these metals have vastly divergent prices. Classifying mines based upon ounces, pounds, tons produced of the particular metals contained in various ores would produce grossly misleading labels. Any/every mine which produced, for example, both precious metals and copper would inevitably be labeled a copper mine, since even if 90% of the revenues came from gold and silver, most of the tonnage would certainly come from copper production, given that copper is so much more plentiful and so much cheaper than gold or silver. Thus, it is obviously necessary to classify mines according to the revenues rather than the tonnage. However, the fact that analysts in this sector never take the time to make their own reasoning explicit in this regard has caused them to misinterpret the data. Without exception, the current scenario where most silver is as a byproduct is treated as a normal state of affairs by these analysts, when in fact it must be nothing but a temporary aberration. Specifically, the only reason why there are so few primary silver mines in the world today is 100% due to the fact that silver is grossly underpriced versus any and every other metal on the planet. A look at a specific example will help to flesh out the parameters here further. For those not especially familiar with mining, the first point to note is that in terms of geology, silver is most commonly found in ore bodies which also host lead and zinc. Whether such mines are classified as silver mines or lead/zinc mines is, as stated earlier, totally dependent upon the revenues produced by each metal. Thus, if silver prices are low while lead and zinc prices are high, these mines will be mostly labeled as lead-zinc mines. However, if silver is priced fairly versus lead and zinc, many of those mines will instantly transform themselves into silver mines. While if silver prices were ever higher versus the prices for lead and zinc, then most of what are currently called lead/zinc mines around the world would become silver mines. The world's largest silver, lead, zinc mine is BHP Billiton's huge Cannington mine in Australia. Conveniently, for purpose of this example, this one mine produces about 7% of the world's supply of primary silver, while also producing roughly 7% of the world's primary lead production. While it is something of a contradiction of logic to simultaneously describe this mine as a primary silver producer and a primary lead producer, when you produce vast quantities of both metals, apparently this causes some loosening of definitions. When we look at revenues, however, any comparison between lead and silver production suddenly become highly lopsided in silver's favor. Taking data from 2006, this mine produced 266,000 metric tons of lead and 38.4 million ounces of silver. With lead prices averaging roughly 50 cents a pound in 2006, while the price of silver averaged a little over $10 an ounce, revenues from lead production would have been roughly $275 million, while silver revenues would have been approximately $400 million, more than 40% higher. If we took these same production numbers and used 2010 prices, we would find that this ratio remained relatively constant. The prices of both metals averaged slightly more than double those of the 2006 prices. However, while silver inventories have plummeted while the prices continue to soar, lead inventories have jumped sharply in recent months based on these historically high lead prices, and like several of the base metals, and unlike silver, lead prices at best might hold steady, while a significant pullback is very probable. Meanwhile, the price of silver is now roughly triple the 2006 price, meaning the huge gap between silver revenues and lead revenues at this time will almost certainly shift much more strongly in silver's favor this year. In case readers are wondering, the grades for both of these metals are especially high for this mine, and if anything, the grades of lead are richer than the silver grades. Thus, it's not as if the silver is produced advantageously versus the lead. This may leave many readers scratching their heads. If silver production tends to produce much higher revenue streams than mining of lesser base metals like lead, zinc, then why did primary silver mines nearly become extinct in the mining industry over recent decades? The answer is not gross revenues, but net profit margins, which are determinative of whether a particular ore body can be mined economically. This simultaneously not only provides us with the explanation as to why there are so few silver mines in the world, but also the proof that their underrepresentation in the mining world is due to silver itself being grossly underpriced. The rich silver grades of the Cannington mine and the vast size of the overall resource meant that this particular ore body would have been economical for silver mining at any recent price level for silver. However, those grades are roughly double the average for other existing silver mines, and most of these mines are also, relatively speaking, high-grade producers. Thus, on the one hand, we have clear evidence that when silver is priced fairly in relation to costs, that silver mining is much more lucrative than most other forms of mining. On the other hand, we have the parallel fact that only high-grade producers have been able to survive/thrive based upon recent silver prices. If only high-grade producers can survive in an especially lucrative sector of the mining industry, this is highly indicative of the fact that silver is significantly undervalued versus the cost of production. If this were not true, then obviously there would be many more low-grade primary silver producers in the world today versus nearly zero. Cementing this argument is the original fact presented in this piece that alone among all the major metals on our planet, only silver relies upon byproduct production for the vast majority of annual mine supply, reinforced by further details from the gold mining industry. Even when gold prices had been manipulated so low that they were below the cost of production for 90% of the world's gold mines, most of the world's gold was still produced from primary gold mines. However, when gold was at its own bottom, the gold-silver ratio was an extremely lopsided ratio of 60-1. In other words, simply moderately underpricing silver could not, and did not lead to the temporary death of most of the world's primary silver mines. Precious metals mining has always been lucrative lucrative to endure such moderate headwinds. It was and is only the gross underpricing of silver which could have ever produced a paradigm where more than 2/3 of silver production is now a mere byproduct. To this point, I have only described the silver mining sector and corrected the misinformation about the nature of silver mining. What is much more interesting and useful for investors is to analyze the current and future impact will be as a result of grossly distorting silver prices and production for decades through deliberately manipulating the price of silver to a mere fraction of its true value. I will provide the remainder analysis in the conclusion of this piece. So, excellent observation by Jeff Nielsen. So, this answers the question. The first question being, what is the cost of producing silver? Well, you're not going to get an honest answer to that question because it's only primary silver mines that are going to even come close to calculating that. The other 2/3 that are produced as a byproduct, then obviously the companies are looking at the cost of producing the primary metal, which is the base metals. So these figures of $5 and $7 for an ounce of silver, you could just actually, if you want to, just say free. Silver is mined for free, and that's because it's a byproduct of these other metals. Well, we know that's just simply not true. They're just not properly calculating the cost. Now, I wanted to prove to you that this is the case. The first idea that I had was that I wanted to look up and see who are the primary silver mines. It turns out that the 1 and 2 primary silver mines in the world today are Pan American Silver and Coeur d'Alene Mines. That's 2 and 1. So Coeur d'Alene's first, and then Pan American Silver. And my theory was that if what Jeff Nielsen is saying is true, and I'm sure that it is, then we would actually see the primary silver mines be in more trouble than the byproduct mines, and that those companies would actually be doing worse. So the first chart that I have here is a chart of Pan American Silver Corp, and it's crossed over the silver price. So you can see in the black here Pan American Silver starting off with the rally in silver. You can see that silver took off in around 2003, a little bit of a rally in 2002, but the main rally happened in 2003. Pan American Silver actually took off before that, rallied. You can see as silver came up, then Pan American Silver took off until we had the Bear Stearns top, and then there was a huge crash in the stock price, and silver not quite as much. But then we turned and rallied from there, and you can see that Pan American Silver went up, made a top with the before the 2011 smackdown. Then the silver price got smacked down, and it was up as much as 850%, came down here to 450%. But the price of the Pan American Silver stock actually came all the way down to this price level here that it was at all the way back in 2004. So there is one indication that what Jeff Nielsen is saying is correct. This primary silver miner, one of the few left in the world, is actually back to the price they were trading at in 2004, while silver is up from roughly about a 50% gain at that time, and the 450% gain, and went as high as an 850% gain. So you can see the difference there. The next chart, this is the #1 primary silver producer in Canada, at least so I'm told by one of the articles that I saw, and this is Alexco Resource. This is Alexco Resource overlaid with the SLV price, and actually that's not even accurate on the SLV, but I'm not sure why. There it is. It's okay, 26. So you can see here that the SLV ran up and had a big spike, and that primary silver producer didn't run up as far but had a spike. And then the price of silver has gone down, but the price of the stock has absolutely plummeted. So you can see that that stock is actually at zero now, a zero return from 2006, while silver still has a 150% return. That's actually the SLV. So that's another chart. And the last chart is an overlay chart of Pan American Silver, BHP Billiton, and the CDE, which is the Coeur d'Alene Mines. You can see at the very bottom here is Coeur d'Alene Mines. It never really did anything. It's pretty much just a dead stock. So that's going to be the number one producer. And the number two is Pan American Silver. You can see, as I pointed out on the other chart, Pan American Silver is back down to the levels it was in 2004. And then we've got BHP Billiton. Now, this is the one that owns that Cannington mine that we were talking about. But of course, they're a big producer of all of the base metals. They're not a primary silver producer. And you can see that the stock for BHP Billiton, although it is down, it pretty much rallied starting in early spring or so of this year, and is still up 500% for this time frame, whereas the Pan American Silver is up a little under 200%, and you can see that the price for Coeur d'Alene Mines is down an enormous amount. In fact, let's just go ahead and pull them up as a separate chart so we can see without the interference of the relative charts. So you can see at one point Coeur d'Alene Mines was a $250 stock. It's now a $20 stock, and it's lost 90% of its value since 1990. So that's what you get when you have a product that you are mining, a metal that you're mining, be suppressed in price, and that's your primary thing that you're selling. There's just simply no way to keep up when the costs of doing so are rising, and the cost or the amount of money you can get for your silver is being held down. Then you're going to decline 90% in value. So hopefully that explains how it's possible that first of all, there are so few primary silver producers. It's so important to understand what Jeff Nielsen pointed out, that primary silver producers can pop out of the woodwork as soon as the price of silver goes to a fair level relative to other metals and relative to the cost of production. And then, of course, the other point is that these people who are making these statements about the cost of production being $5 and $7 is just utterly absurd. That is based on silver being a byproduct of these other metals, and of course there's no accurate way to calculate that, but we do know that the fact that there are so few primary silver mines proves that the price is severely depressed relative to the other metals. So hopefully that clears that up. Now, the last thing I wanted to take you to is the stock chart for Groupon, and this was a dramatic one today, and you can see that this is another one of these IPO internet bubble, some might call them scam stocks, whatever they are. You can see this thing IPO'd back last year in the fall, and it IPO'd at around 25 bucks. We're now down around $5, $5.50 in fact, and you can see, I don't know what the adjusted price is based on today's action, but that price there is at a market cap of $3.56 billion. That cap has probably dropped to under $3 billion, but still, you're talking about a company that really doesn't do anything, and so you can see it appears to me pretty clearly with a 27% drop today that this thing is probably going to go to zero. But with a market cap of still around $3 billion at a price of $5, you can see people basically piling over each other trying to get in short. Now, if you shorted stocks before, you know that 5 is the limit. You're not allowed to short a stock, at least us, the people, the street trader, we're not allowed to short stocks below 5. Now, the street does, and the fancy brokers, dealers, and all those people are allowed to. So, but this is a rush. This is a last-minute rush to get in to short this thing before it goes under 5, because obviously, even though it's as low as $5, when you have a company like this that really doesn't do anything, but its market cap is billions and billions of dollars, and I don't know what the sales are. We can pull up what they say the sales are. Supposedly there's a revenue of $1.87 billion, and they have cash of $1.16 billion. I don't know if that's true or not. I think it'll come out in the wash when this stock goes down. So lots of scam stocks. Priceline being a bubble, I covered that earlier. Facebook being the insiders unloading, and then of course Groupon, just a big giant turkey that the street was trying to unload on unwary investors. And you can see that since the people never learn their lesson, Wall Street just keeps playing the same tricks over and over again. So the silver price is just kind of meandering. We're below 28. We're still trying to put in a bottom here and rally. I think we are going to rally, so it's a very good price to stack. But the main theme, again, being that silver is so underpriced that there are nearly 0 primary silver producers left in the world, and the ones that are their stock prices look like they're going into bankruptcy. At least Coeur d'Alene is very, very low. And Pan American Silver is all the way back to prices it traded at in 2004. So silver is still very, very undervalued at these prices, and anything below 30 is an absolute steal. And we'll talk to you next time.